G'day guys, welcome back to the Devon Too Good investing channel. Today in this video we're going to be doing a Tencent stock valuation and we're going to be adding in the Prosus discount to see just how cheap we can buy Tencent stock via Prosus. So essentially for this valuation I've done a sum of the parts valuation where we take into account Tencent's operating businesses and then also taking into account their investment portfolio. And by doing this, I've separated out the valuation into a bear case, a base case, and a bull case. So let's get into it and let's see what we can expect out of Tencent as an investment, as well as what we can expect out of Prosus as an investment. So if we check out the bear case first, what I've done is I've taken the full year 2021 revenue of $86.4 billion, and pretty much what I've done is I've grown that out 15% per year, as that's what I think Tencent's revenue will grow at in a bear case. Historically, they've grown well over 20% per year, particularly over the last 5 years. And if we jump over the ticker, we can actually see the revenue growth here. We can see that it's a little bit choppy, but they've grown anywhere between 67% and 19% revenue growth per year over the last 5 years. So I do believe adding a 15% growth rate here is fairly conservative and well represents a bear case. If we jump back to the Excel sheet, I've assumed a free cash flow margin in 2026 of 23%. And this is a reduction from what they're doing, what they did from 2021, where they delivered a free cash flow margin of 25.7%. Analysts actually have this number increasing over the next 5 years. So for it to go down, this does represent a bear case. And if we get the revenue and we multiply it by our free cash flow margin, this gives us a 2026 estimated free cash flow of about $40 billion. And if we move down to the next line here, we can see our free cash flow multiple. At the moment, it's trading at about a 19.5 multiple, and I've got that multiple contracting. Honestly, I don't think it will contract, but of course, this is my bear case, so we're going to be ultra conservative here. And then based off that, we can multiply the free cash flow by the free cash flow multiple, and that gives us a operating business value, and that gets us at $640 billion here. So that's the first part of the sum of the parts valuation. So that's the operating businesses. But then of course we got the investment portfolio, and on the annual report, Tencent stated that they think their portfolio is worth about $138 billion US. And I've pretty much grown their portfolio out by 15% per year over the next 5 years. And if we do that, that lands us at $277 billion for their portfolio. So if you add those two together, that brings us to $917 billion. But of course, we've got to incorporate some sort of allowance for their net debt. And currently, Tencent does have net debt of $4.5 billion, and just to be conservative, I've grown that out 20% per year over the next 5 years. So I think in 2026, Tencent will have net debt of $11 billion. And if we take that all into account, that gives Tencent a market capitalization in 2026 of $905 billion. And then to get our price per share, what we need to do is we need to estimate what the shares outstanding are going to be. And over recent years, Tencent has slowly diluted their shares at a rate of about 1% per year. So I've gone out and I've continued to dilute these shares by 1% per year over the next 5 years. And if we take the market cap and divide it by the shares outstanding, that lands us at a share price in 2026 of $88.89. And if we calculate the CAGR on that, that's going to give us a 14% per year return. So I did mention that we would be adding the Prosus discount here. So pretty much what I did was I calculated the net asset value of Prosus 2 days ago, And in this spreadsheet here, I've only accounted the Tencent position. So I've disregarded all the other bits that Prosus owns, such as their Delivery Hero, some of their other listed stocks, and some of the unlisted stocks. I haven't accounted for that. I've only accounted for the Tencent position. And as of 2 days ago, Prosus was trading at a 39% discount when we only account for the Tencent shares. And what I've done here is I've added a effective discount. And what that accounts for is it's me pretty much admitting that I don't think Prosus and Tencent will ever trade 1-for-1. I think Prosus will always trade at some sort of discount to Tencent. However, I think the gap at the moment of 40% is way too large. So of this 39%, I'm saying that the gap will close 60% of that. So that lands us at a effective discount of 23%. So what I've done next is I've pretty much taken 23% off the current share price. I think this was as of yesterday. So I've taken 23% off their current share price, and that lands us at $35.80. And that implies a 20% per year return if you buy Prosus. So assuming these assumptions, by buying Prosus, you are pretty much buying Tencent at $35.80 instead of paying $46.73. So now let's move on to the base case. As you can see for the base case here, I have been a little bit more aggressive. I'm saying that instead of 15% revenue growth, we're going to see 17% revenue growth. And for the free cash flow margin, I'm just going to say that it's going to be reasonably flat in 2026, and it's going to be 25%. So that lands us at a free cash flow of $47.36 billion. And instead of decreasing the free cash flow multiple, I've kept it the same as what it is now. So that lands us at an operating business value of $923 billion. And just for the sake of being conservative, I've left the Tencent portfolio growth at 15%. Historically, they've done a lot better than 15% a year. They've been up in the 20-30% range per year. However, why not just be conservative? We're already predicting fairly quick growth for revenues and some stable free cash flow margins. So this is even more conservative here. So if we jump down, all the rest of the assumptions stayed the same, and we end up landing at a CAGR of 20% per year. So then if we add in the 10-cent discount, instead of assuming that the effective discount is 60% of the total discount, in this assumption, I've assumed 75% of that discount is going to close. So effectively, instead of buying Tencent at $46.73 per share, if you assume that the effective discount is 29%, that gets you an effective discounted share price of $33.06, implying a CAGR of 29% per year. So for the bull case, I've got revenues growing at 19%, free cash flow margin staying stable, and we've got the free cash flow multiple actually expanding from 19.5 to 22. So that gives us a operating business value in 2026 of 1.134 trillion. And for the sake of conservatism, I've only grown out the investment portfolio again by 15% per year. So that gives us a market cap in 2026 of 1.4 trillion. And that gives us a share price in 2026 of $137.42, implying a 24% per year CAGR. And then if we add in the Prosus discount, we've got an effective discount of 31%, assuming that the gap closes to 80%, which means we can effectively buy Tencent at $32.15, implying a 34% CAGR. And of course, There could be even more returns here through buying Prosus because I haven't accounted for any of the other positions or holdings. I pretty much made them worth zero for the sake of this analysis. However, they're definitely not worth zero. But guys, that's pretty much what we got here. I hope you enjoyed this video. Hope it provided you some value. Make sure you like and make sure you subscribe, and have a good one.